So quick tidbit, especially for those of you who've never traded before or have never used algorithmic systems, particularly with the introduction of micro futures in the year, technically 2019 is when they started to roll them out. That brought in a lot more volume, particularly from the retail side, but also from the quantitative and institutional side. We used to see roughly about 40 to 50% of trading being done algorithmically just because systems and technology just was sort of still ramping up. Now it's about 90%, at least as of today. And my guess is within the next 6 to 12 months, it's probably going to get closer to 95, 97, 98%. Manual trading, there are very, 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 very small elite few who do it well. But if you go look at most of the large institutional firms out there, quantitative firms, hedge funds, 90% of what they do is algorithmically done. So if everything's being done algorithmically and the machines are out there competing against each other, it's probably a pretty smart decision to look into working with algorithms and machines and robotic trading on your own with your own capital. That was sort of the stance that I took. I'm a big fan of automations in general, and this is one of the best systems, I guess, that I've personally worked on building over the last couple of years. But I just, generally speaking, algorithmic trading is by far and away the future of trading. A couple of things that I also like to point out about the trading industry generally right now, not so much the industry, but the markets. You'll probably see this on any sort of financial news media outlet, but you'll hear about Buffett hoarding up on cash. Warren Buffett's one of the best traders of all time. His firm's done extremely well. Currently, he is selling off a bunch and starting to stack up on cash. We've also seen a massive amount of these big, huge AI mega trillion-dollar IPOs. I'm sure some of you guys saw the SpaceX thing that happened, and that's had its own. But yeah, so back to this. Obviously, we saw the SpaceX. That also had its own interesting dynamic effects on things like the NASDAQ, with firms being forced to buy in. And if you go look at the charts just in general, you don't have to be overly educated to see that we've been on an insane bull run. And just like anything, when there's ups, there has to be downs. There's mean reversions, there's market cycles. And we're probably in at least what many consider the late innings of a cycle. So we're nearing record highs. We've had some pretty intense IPOs. Retail is now flooding into the markets, and typically that usually points towards things switching up a little bit and maybe reverting back down. Now, I'm not sitting here saying, hey, I believe there's going to be a crash. I am definitely not someone who likes to predict and hope and guess where something's going. Our algorithms that we built here are based on reaction style algorithms, more so than predictive. So no one can really truly predict where the markets are going to go. But if you have systems that can be profitable in both bull runs and bear drops, you're usually going to be in a pretty good position. And that's what we focus on here at Vincere. But that's one thing that you should just really assess with any firm, whether it's us or someone else. Are they buy only, buy and hold only? Those are great when you have the markets running up, but when markets crash, not really the most ideal situation. So most systems out there are buy and hold. It's the easiest to code for it, easiest to go back test. Many people, you can go run a system where you take a 200-day moving average, which is like the average price of an instrument over 200 days averaged out. You'll see it's a simple line on the chart. Very common known strategy with the NASDAQ or the S&P is just wait till it touches the 200-day moving average and buy. Sooner or later, it goes up. Unfortunately, there are crashes that happen. We saw it plenty of times, the dot-com bubble, 2008 real estate bubble. Right now, people are saying a lot of these same signals are there, but most systems rely on markets to just go up. And when bull runs are happening, those systems are great. But what happens when there's crashes? Well, if you're in a bullish only style algorithmic system or portfolio, not really ideal. So what you should really be looking for are market neutral algorithmic systems or market neutral trading systems, where they work when markets are pumping up. They work when markets are taking the elevator down, particularly in a crash. They focus on returns from volatility, not just direction, right? There's not a dependence on just a rising market. So they can make it when it goes up and they can make it when it goes down. Those are scenarios when assessing any sort of algorithm or any algorithmic trading firm that you really want to make sure, at least when you're trying to diversify your portfolio, that you have those bases covered. Now, yes, can there still be algorithms that take small intraday swings that are long only? Sure. But for the most part, you want to make sure that you have systems that are market neutral, not just relying on everything to go up.